Good morning. Shalom. You can see I wore the shirt and jacket from the picture, so I'm all set. I have more clothes, I promise. But thank you very much for the opportunity to be here today. We're thrilled about our new partnership together with Alony Hetz, and very thankful of our existing relationship we have with JP Morgan and the Clark organization. So today I'll tell you a little bit about our firm, Carr Properties. We are what's known as a local sharpshooter in the greater Washington area. So we are a vertically integrated office company. In-house, we have investments, development, asset management, and a property management, and a full-service accounting platform, and have been active in the Washington market since the late 1990s. And my family has been active in the market for over 100 years. So we've got deep roots in the Washington area, and that experience in the market gives us access to every opportunity in the marketplace. A bit about the company. Today we own about 3.5 million square feet of property, and that includes 3 million square feet of existing buildings and approximately 500,000 square feet of development in process. That includes 2 buildings currently under construction and 2 that are in the initial planning stages. The total value of the assets of the company is approximately $1.1 billion. Our pro rata share of those assets is approximately $823 million, and that's broken out into just over $700 million in existing properties and approximately $100 million worth of assets in development. Looking forward, after this transaction with Alony Hetz is completed, the company will be held in equal parts by the Special Situation Property Fund of JP Morgan and Alony Hetz, both holding roughly 45% of the company, and the remaining 10% will be held by interests of my family as well as the Clark organization. Bit of history about the company. As Avi mentioned, again, we've been active in the Washington market for many years. Really started investing actively in the late 1990s, and we built up I'd say relatively small portfolio that we grew, over time from the late 90s through 2005. And once we had achieved scale, we looked at options to raise capital and took the platform public as Columbia Equity Trust. So we were a New York Stock Exchange traded office REIT focused on investing and developing in the greater Washington market. In 2007, we were approached by one of our longtime partners in JP Morgan Asset Management, and the company was taken private in a merger transaction. So we were just public for something less than 2 years. From the date of our merger with JP Morgan, we've been quite active. We've acquired approximately $600 million of additional assets, completed 2 developments in the last few years, 901 K Street and 1701 Duke Street, which is located in Alexandria, Virginia. And today we're underway with 4 additional development projects, as I mentioned. Looking forward, we will have a balanced strategy. So we'll operate very much like a public REIT, and our investment focus will be approximately 85% investing in income-oriented, more stable assets, with approximately 15% of the capital investing in more risk through development and buying properties we see have some risk on the front end, but over time should generate substantial upside value. So through that balanced approach, we look to provide a nice proportion of income and growth over time. This is what we look like today as a company. So as I mentioned, a portfolio of roughly 3.5 million feet. Our current occupancy across the portfolio is just over 86%. We have several properties that are still maturing, still in lease up. On the development side, approximately 500,000 underway. And as I mentioned, our total asset base is $823 million. If you look at our lease expiration schedule, we really don't face much concentration risk in terms of rollover in any one year. And you can see that a significant portion of our leases mature beyond 2019. Approximately 91% of our assets today are what we would term core or stable income-oriented properties, with a smaller percentage in value-add, riskier buildings that are still being leased up, as well as development. We are also diverse geographically. You can see both by value and square footage that we are spread approximately, on value, approximately 34% in Washington, D.C., so in the city itself, and the remainder in close-in Maryland and close-in Virginia. I think this slide is what got Alony Hetz most interested in the company. There's significant potential upside in our NOI. So with the growth capital from Alony Hetz, we believe that we'll be able to grow our net operating income by approximately 140% from today through 2016. And that growth will be achieved through a combination of income from new acquisitions and from harvesting gains from the existing assets and development. This is a map of our assets in Washington. So in the city proper, 7 buildings out of our existing portfolio are located in D.C. The bulk are in the central business district.
Where's the White House? People can understand. Can you show where's the White House in this?
I don't think I can reach the map, Nathan, but if you look at building number 7, that's a project we have under development, 1700 New York Avenue. The White House is right next to number 7, if you can see that on the chart. So if you look at our asset grouping in the city, all of our buildings in the city, with the exception of one in Georgetown, are within easy walking distance to the metro, close to the White House, close to the Treasury Department, very much in the heart of the central business district. Holdings in Maryland and Virginia. This is a significant portion of our portfolio, but I do want to explain many of these assets are very urban in nature. So the ring you see is our major beltway in the Washington area. So that's the highway, that surrounds the city. And you can see that the majority of our assets are located inside the beltway. That's the more urban core of our region. And the bulk of the assets inside the beltway are also located right on the metro. So these are properties in Arlington, Virginia, Alexandria, Virginia, Bethesda, Maryland, Chevy Chase, Maryland. These markets are very much like the city. They're 24-hour locations, great housing, retail, restaurants, and access to the metro system. A couple of case studies for you. The building on the left is 901 K Street. That's a building that we completed in 2009. This is a LEED Gold, best-in-class new building that we built in the east end of Washington. This asset is located directly across the street from the D.C. Convention Center, which is a 2 million square foot cutting-edge convention facility, major hotels. So this is a true center city location. We delivered this building and successfully have gotten it leased up to 91%. And you can see by the quality of the credit roster, it's a first-class building. So our lead tenants there include Baker Donaldson, Microsoft, so great brands in the D.C. market. The building on the right is the Barlow building. That's a very unique asset. This is the largest and highest quality medical office building in the greater Washington area. This is located in Chevy Chase, Maryland, which is just over the line from Washington, D.C. is also a very easy walk to the metro station in Chevy Chase. This was a unique transaction. So many of the assets that we buy, there's usually some angle. There's a story or a way to get control of the building, privately outside of the full marketing process. This particular asset we acquired through a very complicated merger transaction. The seller had tax issues and actually owned this building in a corporation, and we were the only buyer who was able to figure out how to successfully complete the merger and protect the seller's tax issues. So again, we like to use, our market knowledge and unique skills as a way to control transactions off market. This is a sample of a couple of buildings we have in development. So the building on the left, 1700 New York Avenue, this was number 7 on the map of the city. That's approximately 1 block from the White House. This is a piece of land we acquired several years ago, and this site is one of the best in the city. When you get above the 5th floor of this building, the entire National Mall opens up. So the views of the Washington Monument, of the Lincoln Memorial, of the Jefferson Memorial, the whole city really unfolds in front of you. And we were the only buyer who understood, what the view potential was like from the building. It's a high quality asset. It's being built to a LEED Gold standard, and today the building is 80% pre-leased. And this asset will be complete later this summer. 4500 East-West Highway. This is in the Bethesda, Maryland market, which again is a very, urban market, feels just like you're in Washington. 4500 will be the first new building built in that market in 12 years. Bethesda is a market that has very little space available. So any large tenants looking for new high-quality space will look at 4500 East-West Highway. So it'll be the best building ever built in the market, built to a LEED Platinum standard, full-height glass, tremendous views, all the amenities that today's tenants are looking for. And again, it's approximately 2 blocks from the Bethesda Metro, so transportation is excellent. As I mentioned, our strategy is investing into a mix of both income and riskier development assets, but with the majority of capital focused on investments in stable income-oriented properties. Our philosophy in terms of our balance sheet is similar, where we want to take a very conservative approach. So generally, the company will not be financed much in excess of 50%, and in fact, when we close on the transaction with Alony Hetz, we will reduce our leverage, which stands today at about 46%, down to 23%. So we'll have a very conservative balance sheet. At the time we consider a public offering, we'll of course reduce our debt down to public market standards, which would be something in the range of 40% leverage. Here's a view of our financing at the time of the closing with Alony Hetz. So I mentioned a conservative leverage approach. You can see that almost 70% of our debt is fixed rate, so we're locking in today's very attractive yields, and a significant portion of our debt matures beyond 2019. Our plan is to take advantage of unsecured corporate financing, which will give us a lot of flexibility as a company and will allow us to be quite nimble on the acquisition side, being able to draw capital from our balance sheet to move very quickly. Here's a view of the structure of the company. So as I mentioned, JP Morgan's Special Situation Property Fund and Alony Hetz will be equal partners in the business, roughly owning 45% each, and then a share held by my family and the Clark organization being 10% owners in the company. The portfolio on day one will include 18 more stable income-oriented assets, 2 buildings we own that are still in lease-up, so we term those value-add properties, and 4 development projects. And as a platform, I mentioned we're a fully integrated company. So as part of this transaction, It will include our, total management, property management company, asset management company, et cetera. We're very fortunate to have what I think are the best partners we could possibly have for our platform, obviously including Alony Hetz as well. A bit about our partners, JP Morgan Asset Management. These numbers here are a bit outdated. As a platform, manage approximately $65 billion of assets, both in the U.S. and globally. And the Special Situation Property Fund, which owns our company, has approximately $3 billion in assets and approximately $2 billion in net equity. And they've got a incredible, very deep team of professionals that are there, to make the investment in car properties work. In terms of my family, my father started a development company in Washington back in the 60s and was one of the largest developers in the region, building over 15 million square feet of space. Together with some of his existing partners, he'll remain a key investor and supporter in the company. And the Clark platform, Clark Construction, Clark Enterprises, they've been a partner of ours back to the beginning. They invested in some of our very first buildings with us in the late 90s. Clark is a dominant construction company in the U.S., very active nationally, and as you can see, they're a force with over $4 billion in revenue. And we're thrilled to have Rebecca Owen here today representing Clark and look forward to continuing that partnership together. So to summarize, we're very excited about this opportunity. We've got, I think, together with Alony Hetz, JP Morgan, and Clark, the best investment partners we could have for our business. It'll allow us to be quite active, take advantage of market opportunities we see in the greater Washington area, and be nimble. Our balance sheet flexibility will allow us to move very quickly. We're unique in the Washington area. We're one of only a handful of vertically integrated office companies, so we're a full-service shop with, again, investment, development, asset management, property management, and accounting in-house. Our portfolio is extremely high quality. As you see, the majority of our assets are held either in the city or in the close-in urban markets, and our balance sheet offers us the ability to grow without raising additional equity. Thank you very much.